Patrick Malcolm. I'm a senior partner at GFM Wealth. Thank you for joining us for our first webinar for 2021 to hear about the Munro Global Growth Fund. I'll introduce our special guest, Nick Griffin, in a moment. I know it's February, but I think I can get away with saying Happy New Year. I hope everyone had a lovely Christmas and got to enjoy it with family and friends. As we let our clients know in late last year, we're planning to return to face-to-face seminars in 2021 when it's safe and practical to do so. Obviously, the events of the last week make that a little bit tricky at present. Now, as we do in all our webinars, I need to share our disclaimer. And effectively what we're saying here is that this is general advice today. It's not specific to your circumstances. Should you want specific financial planning advice to your circumstances, you need to speak with one of our financial planners. So before I introduce Nick, I'll talk a little bit about Munro. Munro is an independent global investment manager with a core focus on global equities. Munro provides all investors with an institutional quality global fund manager with the ability to identify sustainable growth trends that are underappreciated and mispriced by the market and the resulting winning and losing stocks. Munro partners are a team of like-minded individuals with previous working relationships that have come together to build, own, and operate a successful global equities fund manager. Now that's all rhetoric. The proof of the pudding is in the eating. Since inception in August 2016, the fund has produced an impressive return of 17.8% to the end of January. Nick Griffin is a founding partner and the Chief Investment Officer of Munro Partners. He's responsible for the investment management of Munro's key investment funds and the formulation and implementation of the proprietary investment process. Nick's been managing global long-short equity strategies for 15 years. His highlights include 20 years in financial services, with 15 years funds management experience. From 2005 to 2015, he was head of international on the K2 Select International Absolute Return Fund. He was a member of the K2 Asset Management, Asset Allocation and Currency Exposure Committee. From 2000 to 2005, he worked for Deutsche Bank in the UK. And from 1996 to 1999, he was the manager Australian equities for Commonwealth Financial Services. Good morning, Nick. Thanks for joining us today.
Morning, Patrick. Thanks for having me.
Now, I think we're going to get along okay, Nick. We've got 2 out of 3, which isn't bad. You like your golf?
Yep.
Which is good. You're a University of Melbourne alumni, which is good as well. So we've got 2, but you're barracked for Collingwood.
Yeah. I mean, some things you're just born into, unfortunately, Patrick, and I can see the. I have sympathy with people that don't like Collingwood supporters.
No, I don't.
My wife is Scottish, and she arrived, and it didn't take her long to work out. She's like, I just don't understand why you're back for Collingwood. You don't feel like a Collingwood supporter, but some things you're just born into. And
so many places we could head with that, Nick, but we won't, given that we're going to try and keep things pretty serious today. Now, lockdown, you've got 4 boys, including twins. So I want to ask how you manage through lockdown. And I also want to ask what your grocery bill is like each week.
So the grocery bill is huge. Actually, it's massive. Actually, we might talk about it today when we talk about HelloFresh, maybe as one of our stock ideas. But grocery bill's big. Lockdown was okay. For someone like me who normally travels quite a lot to see companies or to work, I'm one of those lucky people who got to stay home for the whole year and spend more time with my family, which was really nice.
Good stuff. Now, just to make a start, Nick, in your literature, you talk about trying to pick growth stocks that keep on winning. So could you maybe just talk about what that actually means and how you go about doing that?
Yeah, so I'm going to share a screen if that's okay for a
Absolutely.
second, Patrick. I'll just, I promise I'm not going to do all these slides. We're just going to talk big picture stuff today. Keep it fairly simple. When we set up Munro Partners, we wanted to be Australia's global growth manager. And so what do we mean by that? We mean that we're sort of a glass half full guys. So we're sort of the guys who say, could streaming take over TV 5 years ago, and should we invest in Netflix? Or is e-commerce going to be really big and invest in Amazon in 2013? And as a growth investor, our job really is to be looking for these next great growth companies. That's what we're trying to do, and we're trying to put it in a really concentrated portfolio of 30 to 50 ideas, which we quote on the Australian Stock Exchange under MAET. And so if you buy that code, which many of your clients have, Patrick, thank you very much.
Absolutely, yes.
You just get straight through access to all these great ideas. And so what you're actually checking with us today is how do we come up with the ideas? And so from our point of view, and I'm just skipping a few slides here, what we're saying when we look for great growth ideas is we just think that equities is a game of very few winners and lots of losers. And most of the equity market has got these sort of macroeconomics companies, so like banks or resources or supermarkets, etc. And as growth investors, we're not looking for that. And so what I'm showing you here is two slides. One is a picture of Bank of America in the US. That's the share price, and that's its 12-month forward rolling earnings per share growth. And the other one is MasterCard, and that's its share price and its 12-month forward rolling earnings per share growth. And so what we're saying is we don't actually have a strong view on where Bank of America is going to go because we don't know where the earnings are going to go. The earnings rely on macroeconomics. They rely on interest rates. They rely on a whole bunch of things. We have a view, but our view is as good as someone else's. As a growth investor, we're trying to find these structural winners like MasterCard. And MasterCard benefits from the shift from physical to digital cash. And what's fascinating is everybody knows this. So what we're basically saying is earnings growth drives stock prices, sustained earnings growth is worth more than cyclical earnings growth, and the market misprices growth and sustainability. And so our job as your global growth investor is really just to find this situation over and over again, all around the world. And if you just give me one more slide, Patrick, I'll just explain why we think this matters. Is because the reason why we think about the world this way is because ultimately it's all that really matters. I mean, as in life, and many people on this call will know that, and it's the same in equity markets, it's essentially full of a handful of exceptional companies and thousands and thousands of really mediocre ones. And so this is just a simple study that was done by a guy called Henrik Bessenbinder, and he said, what would happen if you bought and held every company that ever listed on the US stock market in the last 90 years? So like every company that ever listed. It's actually 26,500 companies. This is the mathematical statistical test you can do. And out of those 26,500 companies, if you bought and held all of them, 96% of them created no value. So 14,000 went to zero. The other 8,000 only offset what the other 14,000 lose, and you end up with 1,000 that create all the value. And the top 50 of those 1,000 create nearly 50% of the value. So that's 50 companies out of 25,600. And these are the companies. I plotted them on the slide for you here today. This is their life and months, their annualized return, and your job is to find them. That's what you're paying us to do. And so the last thing we just say is what we're trying to do here every day at Munro is they're always driven by structural change. So it's either Amazon or Facebook in digitalization, but that's the big structural change of our lifetime. So that's the near one. But if you go back in time, this has actually happened before. It happened with software, or it happened with big box retailing with like Walmart and Home Depot, or it happened with quick service restaurants, or it happened with entertainment, or it happened with aerospace, and you could go all the way back to Coke and Pepsi. It's always the same. There's a big structural change. There's a couple of winners. To the winners go the spoils. And so our job as your global growth investors is really to do these 500 meetings per annum that I was talking about with the travel, to try and meet as many companies as we can, to identify these structural areas of interest, to focus on 1,000 stock universe. And really what we're going to be spending a lot of time today talking about is trying to identify the companies that are going to appear in this slide in the future, because we don't know what's going to happen in the next 90 years. The world we know will change. We will hopefully identify the structural winners, and that's ultimately what drives our returns, Patrick. And we put that, as I said, in a fairly concentrated portfolio.
So I guess a good place to start is an outlook for markets and an outlook for the portfolio as well, Nick, if you wouldn't mind.
Yeah, so from our point of view, as I said, and I apologies if that was cutting in and out a bit, and let me know if it happens again, Patrick.
No, good now.
So what we're trying to do is we're trying to find these big winners. This is what we're trying to do. Now, within that, there's going to be bumps along the ride. Markets will go up and down. Stocks will go up and down. That's what happens in equity markets. From our point of view, a lot of people right now are looking at the equity market saying, it's had a really good run. It looks overvalued. Are we in a bubble? Et cetera. And we would argue that if you look at the overall equity market, that it's not actually in a bubble at the moment. And the reason why is because it's being supported by very, very low interest rates. Now you could argue interest rate market's in a bubble. That I'd have some sympathy with, but the equity market is not in a bubble. And the reason why I know this is because we look at a slide like this. So this is what we call the equity risk premium for markets. So if you take the PE of the market at 20 times and you do 1 divided by the PE, then the earnings yield for the market is 5% roughly. Now, it's a little bit more expensive than that, but it's roughly 5% is your earnings carry for owning equities. It's no different to the rent carry you would own on an investment property. And then if you subtract the risk-free rate, which is the US 10-year bond, you're getting roughly a 4% carry for owning equities. And so this is the equity risk premium over time, over the last 20 years. And so what you can see is that, equities are no more expensive than they've been at any time in the last decade. And they're definitely nowhere near as expensive as they were all the way back in 2000. But what is this is all being supported by low interest rates, because the difference in this chart is back here, interest rates are 1%, back here, interest rates were 6%. And so what you have to try and work out as an investor, and everybody on this call's got the same problem, is if you leave your money in cash, you're not going to get a return on it. So you're effectively taking risk to get a return. And so that's going to cause this arbitrage. Something's got to happen to cause this arbitrage to close. And so from our point of view, 3 things could happen. One, earnings could go down a lot and move that level. And we think that's unlikely because we're in economic recovery. Interest rates could go up a lot. That could happen if inflation came back or something along those lines, but the Fed and the RBA don't want to do that, and they're very clear on that. And so the last thing that could happen is markets could go up a lot. And so the path of least resistance to us, at least, seems to be for equities to raise higher slowly over time at the whole market level. And so as it is today, this is a chart that we use for a long period of time, and this is what we follow, and we do think there's an upside there to markets. Cool. There is one other point I'd just make really quickly, Patrick, on this, which a lot of people miss, and it's important to stress on the call, is the equity market is not actually the economy. And so there's this simple assumption that the equity market and the economy should do the same thing, and it's just not true. 65% of the economy is not listed. If you take the top 10 companies in the S&P 500 today on the left here, they make up 31% of the market. This is their 5-year average sales growth over the last 5 years. So not what they did in the last 5 years, what they did per annum in the last 5 years.
Yep.
And so as far as I'm aware, the economy is only growing at 2 or 3%, yet all these companies are growing at double digit. And that's because they're disrupting, or because they're making structural change, or they're just taking share from smaller businesses. And so the pure mass of the equity market actually adds up here. And that's why we're reasonably positive markets.
Thanks, Nick. That's pretty clear. Now, you caught up with our team sort of just the other side of COVID, where the world was still trying to work out, or markets were still trying to work out where things are at. And you made a very succinct point around the fiscal and monetary packages that were rolled out. And you described them as being compensation rather than stimulus. And I use this a lot when speaking with my clients. And you made a point around this being a health crisis that has caused an economic crisis, and it not being an economic crisis. So can you talk about that a little bit? Because I think it links back to your previous point around interest rates being low and so on.
Yeah, so let's bring that back to the top. So because it is a health crisis, not a financial crisis, there is a lot of suffering in the world, quite frankly. And a lot of that suffering is disproportionately being felt by small businesses, family-run businesses, your corner shops. I'm sure everyone on the call would know people or is familiar with this situation. And so the central banks and the government has to support the whole economy. And so they're doing this with stimulus and excessive stimulus. So there's no real moral hazard here. There's no you deserve to go broke here because you took too much risk. No, there's a global pandemic and we need to help you out. So we're just going to give you this money. And so you've got fiscal irresponsibility on a massive scale. And so you're getting a lot of stimulus putting in the market, which is creating growth. And that money is being spent. So that's supporting us through this environment. The second thing that's happening is really on this chart on the right here, is that because they've lowered interest rates so far to deal with this, and because even corporate credit, so this is the rate you borrow corporate credit at in the US, it's an ETF of corporate credit, of investment grade credit. And that's what you can borrow at before the crisis. That's the crisis. That's what you can borrow at after the crisis. So central banks have made it so easy to borrow money that you can borrow money now cheaper than you could before the crisis. And so even if you're a company that's affected like this, like a Starbucks or a Walt Disney, you're borrowing money so cheap that you're actually just continuing to take share from these smaller companies. And so the reason why the equity market's doing so well, but the economy is doing so badly, is because inequality is getting driven up at a really rapid rate here. And that's a real shame, and it's not ideal, and there will be consequences down the track. But this is how policymakers solve a problem like this. And I think that they will continue to solve it this way because it's the best way to solve it. It's the way they get the economy going again and to get things solved. And so the big companies are benefiting, and that's why the US stock market's doing better than most markets in the world, because that's where the biggest companies are.
Understood. Now, I think your fund is a long-short fund.
Yep.
And it's amazing how considerable the collective population understands short selling a lot better, Nick, given the events of the last 3 weeks. I've got friends asking me about liquidity squeezes and gamma and this sort of stuff, which is just incredible. So I think it would be good if you explained to our listeners what short selling is. And your fund that you referenced before, MATE, M-A-E-T, does have the word hedge fund at the end, which is a very, very generic term. I think it's far too generic a term, but nonetheless. But could you talk a little bit about the concept of short selling, how you use it, and really about this term hedge fund?
Yeah, so I'm just going to move slides here quickly. I'll just jump around a bit here.
Done any GameStop, Nick?
GameStop? No GameStop. No GameStop, I'm afraid. I've got a slide on it if you want, but let's just cover the short selling and then I'll cover GameStop.
Absolutely.
So what do we do here? We run an absolute return fund at Munro Partners. So our goal here is we're not trying to, sorry, I might just go back one slide. We're not trying to outperform the index. We're trying to get you an absolute return. And so that we think is a double-digit per annum return after all fees and expenses on a 3 to 5 year view. That's what we're targeting. And we've actually done that now for 4 years at Munro at 17.8% per annum, as Patrick said. And we actually did it for 10 years at our previous firm at over 16% per annum. And so what you're doing there is with the ability to do the downside protection is we're doing the bit in white, which is what every fund manager in the world does, and we do it as well, which is that we have an investment team that has an investment process. It picks stocks. We do active research. We happen to be a growth equity manager. Some people are value managers. Some people are bond managers. And then all we have, as Patrick mentioned, is these other tools that basically qualify us as a hedge fund or an absolute return fund. And that's first and foremost our ability just to hold more cash. Sometimes it just makes sense to hold more cash. We can also short sell. So when we are short selling, to be really clear, you are betting on a company going down. So we borrow the stock and sell it. And then when it goes down, we buy it back again at a profit. It's important to stress that short selling is a useful tool, but you can only actually make 100% out of a short. A company can't fall more than 100%. Like, it's impossible. And you can lose an unlimited amount of money shorting. And so you need to be very aware of that. And obviously, a couple of people did lose an unlimited amount of money on GameStop recently. And so from that point of view, we put very, very strong risk controls around our short selling. It's a useful tool, but the way to think about it is a bit like your left foot. Sometimes, you kick better with your right, but it's handy to be able to kick with your left, and not everyone else can. The other thing we can do is buy things like a put option on the market. Super helpful, especially for something like COVID. And I'll show you in a second how helpful it was. Because, COVID, I'm going to put my hand up and say, I thought it was just a flu. I was that guy, I was that guy at the dinner party saying, hey, this is just a flu. And I was wrong. But put option was a perfect way of just hedging the portfolio over it. And that's something we actually did last year. And so these are some of the tools. And to show you how they work just really quickly, this is the net and gross exposure of the fund over time. So the fund, like a normal fund, many funds you invest in are just 95% invested all the time. They just have to be invested all the time. And so they'll go up with the market and they'll go down with the market. But this product's designed for retail investors who don't like losing money, quite frankly, and nor do I. So we have the ability to lower the exposure of the fund. And so what we're showing you here is how we dropped the exposure in 2018 from 80% to 20. And you can see here in COVID, the fund was 80% invested. We dropped it all the way to 20 really quickly. And down the bottom there, you can see the short exposure, which is generally fairly small, but we use that left foot. We used that left foot quite effectively in the COVID era. And on top of that, we used things like put options, which made that exposure come down quite a lot. So we didn't actually sell the whole portfolio. We just had a put option on the market. And just to show you
betting on, so our clients understand, betting on the market to fall.
Well, it's actually just buying insurance on the market to fall.
Yep.
So it's an insurance thing. So in this case, we spent, I'll just show you what happened. You know, we spent 35 basis points of the fund's performance.
It was pretty cheap leading into COVID, wasn't it?
Yeah, it was really cheap. So we spent about 30. So we spent about 30 basis points. So 0.3% is what we spent on that insurance policy, and in the end, that insurance policy made us nearly 7%. So we had a well over 1,000%. In fact, we had a 2,000% return on that investment. And so from that point of view, these are some of the things that we can do. And so this just shows you what happened to the fund in that COVID quarter and also what happened back in 2018. And so like any investor in equities, you're taking risk. You know, markets go down, our stocks go down. That's what happens, okay? That's what happened here in 2018 and that's what happened here in 2020. But these extra tools, i.e. short equity, when used well, allowed us to offset that fall, as did that put option allowed us to offset that fall. And that last bit is just US dollars holdings, which actually meant we made money through COVID, which was us doing it really well. But this one back in 2018, just to be clear, you know, in this one, we still did have a 10% return. We're not pretending that we can make money in any environment. What we're saying is we have these downside tools and we can use them to help smooth the ride for clients. And that's what
and historically, this fund, as well as your time at K2, has held up historically very well in down markets.
Yeah, and so the thing we show just really quickly to come across it, this is the performance of the Munro Global Growth Fund over the last 4.5 years since we started it. And as Patrick said at the start, what we're really focused on is that 17.8% per annum, or better than 10% per annum through the cycle. And what you can see here at the bottom is what we're doing is we're hopefully trying to smooth the ride for people who, you know, quite frankly, are nervous about investing globally or nervous about investing growth stocks. And you can see that the beta is actually below the market, so it's less volatile than the market, or we capture 80% of the upside, but only 24% of the downside. And so these are some numbers that Patrick and people who look at funds will look at to say,
absolutely, there's super impressive numbers.
Is this suitable for the client?
50% for downside is super impressive, and it's one of the things that we very much focus on with clients, Nick, because it preserves your wealth in difficult times and gives you the ability to compound it as markets recover, which these numbers show it's done.
Yeah, agreed. And so this is where people just try and work out what's most suitable for the person on the call, and that's what Patrick and Paul and the rest of the team do there at GFM.
Cool. Now, one of the things that has resonated with our clients a lot when introducing this fund to them, Nick, is how you break up the portfolio. Often we're speaking with clients when looking at a fund profile, they look at GICS sectors and they get a little bit confused because it can be pretty meaningless, and there can be some stocks that fit into GICS sectors which sometimes don't make sense. But you break the portfolio into areas of interest, which is quite interesting. Can you talk about this concept of areas of interest and the types of areas of interest that you've got in the portfolio at the moment?
Yeah, so thank you. It's a good question. And so I agree. I think gig sectors are probably some of the dumbest things ever created because they're designed to try and tell a fund manager how they should look at the world. And the problem is when I'm walking down the street and I look at a company and, you know, Uber is apparently an industrial. I don't think Uber's an industrial. Or when I look at Amazon, they think it's a consumer discretionary company. I don't think it is. It's a tech company. And so they're trying to fit things into buckets and be over and underweight certain sectors, and it just makes no sense whatsoever. The reality is this is a game of very few winners and lots of losers. We discussed that at the start. You're going to find them by identifying structural change. We also discussed that at the start. And so in our monthly reports, which we update every month, we show a chart like this. And so these are the areas where we think structural change is occurring. And so these structural changes we're looking at the moment, and we update it every month, is climate or digital enterprise. So in climate, we're basically saying these are companies that are going to benefit from the efforts to decarbonize the planet. It makes up 16% of the portfolio today. There's 8 holdings, of which Ørsted in Denmark is one of the largest. Digital enterprise is cloud computing effectively, or any company that helps you transform your business digitally. Here, it makes up 16% of the fall area. There's 6 holdings. Microsoft's the biggest, but it also includes things like Atlassian and ServiceNow, and could also include Zoom at some point in the future. Those are the sorts of things we're looking at. E-commerce is a very obvious structural change that's occurring in the world today. 15% of the fund, 4 stocks. Amazon's the biggest. HelloFresh is the smallest. High performance computing is semiconductors, healthcare, internet disruption, digital payments. And so what we're trying to do here, Patrick, is we're trying to create a range of different idiosyncratic growth drivers, which will ultimately equal earnings growth for a number of the companies that we invest in. And then ultimately, as I said at the start, the share prices should follow their earnings growth over time, which will lead us towards our excess returns. And that's what we're trying to do when we put
So can I ask a question
together.
with the areas of interest? And I know it's a really hard question because I can only imagine from time to time it's more on the stocks and more on the areas of interest, but how does your team sort of divide their time between focusing on the areas of interest versus finding stocks that fall into the areas of interest and paying the right prices for those stocks?
Yeah, okay, so it's a good question. So this is just a good slide, and I'll just get you to concentrate on the left of it. What we're looking for when we look at these areas of interest is we're looking at these S-curve type situations. And this S-curve on the left is a good one because it really just, everyone on the call probably knows it, right? And this was the shift from feature phones to smartphones. So about 12 years ago today, you're probably sitting at a dinner party and someone pulled out an iPhone and they said, look at this, I can get the internet on my phone. And you went, oh, wow, but I don't like the touch screen. I want the buttons. I like my BlackBerry. I'm not going the touch screen, yada, yada, yada. And they're like, it's awesome, but it's $1,000. And you're like, $1,000, a phone should only be $200. You know, that's what my Nokia 6110 is, right? That's what was happening back then in 2008. And so this is a classic S-curve situation. And so what you know is smartphones is a better product. Everyone's going to use it. They go from a 10% share to an 80% share. And so all you had to do was work out, that would happen. And then you model that out and work out, well, who's going to get the biggest market share? Is it Apple? Is it Samsung? Is it HTC? Is it BlackBerry? And so this ultimately drove Apple from a 50 billion market cap to 2 trillion. And so this S-curve, or this area of interest, we called connectivity at the time. We want to be involved in smartphones. We've literally got 12 companies we can choose from. Let's try and choose the right one. And the reason why we chose it, Patrick, is because it's right at the start of that inflection, if that makes sense. So this is where you get your best bang for your buck, in the middle here. The ones that we focus on at the moment are these ones. And so the reason why we've chosen the ones I just showed you is because a lot of these S-curves are only just getting going. And so this bottom one is e-commerce as a share of retail sales in the US. And up until 2020, it was only 20% of all retail sales. In Australia, it's less than 20% of all retail sales. It's clearly going to be at least 40 to 50 at some point in the future. So you are actually in the accelerating part of the S-curve. Cloud computing is the same. You're in this accelerating part of adopting digital software, as it is with, and less so with digital payments and e-commerce, which are more, digital advertising, which is more mature. And so the reason why we've chosen the ones I showed you is because of COVID, they're all accelerating. And so we were discussing it before we jumped on the call, and the fact we're on a webinar tells you, we're all effectively adopting software at an accelerating rate, which means these companies are appearing faster and faster. Zoom's appearing literally out of thin air, or companies like ServiceNow or Twilio that I'm not expecting everyone to understand, but these are going to be or Atlassian, even here in Australia, they're going to be your next Microsofts. They're going to be your next Salesforce.com, which is one you've probably heard of. And this is accelerating. So these are the areas we want to focus on because it's the area where the most change is happening. And that's why we pick those areas of interest.
Yeah. Now we're going to go back to the first area of interest, the largest one in the portfolio at the moment now. And you've got a little bit of press about this in the last sort of few weeks, Nick, around climate change. And I must say, it's a question that we do get from clients. How do I play this climate change theme? So I'm perhaps keen to understand why you think climate change is a good area of interest to be exposed to in terms of excess returns, and maybe just touch on a couple of the stocks that you've got in that parcel of the portfolio.
Yeah, so as I said, so our job as your global growth manager is to identify the area of structural change, which I'm showing you 7 here. We actually have 20 that we look at, and climate's the biggest one today. And so why is climate the biggest one today? Because it's really right at the start of that change, and this is why we just get the most upside, if that makes sense. So if I just scroll this out and go back to here. So why do we think climate's happening? So we were really looking at this a lot back in 2005, 2006, 2007, and then the financial crisis came along and we couldn't afford to save the planet anymore, which seems dumb, but that's what happened. And then back in 17, 18, and 19, this really started to get some momentum. And it came actually not from countries, but it came from corporates. So the companies themselves recognized that stakeholders, customers, shareholders wanted this to happen. And so you started seeing companies like Microsoft, Google, Amazon commit to a zero carbon target by 2050. And then you saw Europe commit to a zero carbon target by 2050. And then you saw the UK do it as well. Now we've seen China do it by 2060. And I'm pretty sure the US will do it at some point. And eventually Australia will do it, but it doesn't really matter if Australia does or it doesn't, because your local council, your local state, your local company is going to do it anyway. And so the important thing about these targets is you're basically saying zero carbon by 2050, not we're going to emit no more, we're going to emit no carbon. And that's just going to cost an awful lot of money.
Now, just to be clear here, and the quote in the press is you've called this the biggest investment theme of our lifetimes, bigger than the internet, Nick.
No, I said it could be as big as the internet.
Could be, okay, so apologies.
But I might have got misquoted.
Don't let the truth get in the way of a good story.
Yeah, so, but truthfully, you know, the reality is this is going to cost, we think, $30 trillion minimum over 30 years. And if you think about the internet, it was something that happened all the way back in 1999. And we're 21 years later, and it's still disrupting businesses on a regular basis. So to move from a fossil energy fuel to a zero carbon fuel is going to be a huge disruption. And we are right at the start of it. So if I look at my investment career, we've basically made a lot of money playing the same trick over and over again, which was Google into Facebook, into Apple into Google, into Facebook, into Netflix, into Spotify, etc. It was the same disruption. It was the same playbook the whole way. The same thing's going to happen here. And you've already got one big company in Tesla, which we can talk about if you want. But I think what's more important is not to get too wound up about the Tesla valuation, but just to realize there's whole other areas like energy efficiency, renewables, etc. And so just to run it through just really quickly, you know, this is global offshore wind and onshore wind. This is how much is installed today. This is where you're going to have to get to zero carbon. Otherwise, you're not going to achieve your target. So one or the other thing's going to happen. These companies, this whole area is going to explode, or we're just going to give up. And I just don't see us giving up at this point. I think we're past the tipping point. And so there's companies like Ørsted that win here, Vestas that win here. They're both listed in Denmark. This is global batteries. So this is what the battery market is going to have to get to in terms of getting this to happen. And here we can look at Samsung SDI in Korea is the one we own, or you could buy Cattle in China or LG in Taiwan. And then from that point of view, these are the companies that are going to win from this. And then the last one is obviously electric cars. You know, it's literally 3% of all car sales today. But Tesla is 26% of all electric cars. Now we know by 2040, 80% of all cars sold in the world will be electric. It's highly likely to happen from here, based on what we're saying from the targets. And if that happens, you know, what's Tesla's market share going to be? 26%? Probably not. 15? Maybe. 5? Maybe. And out of that, you can actually value Tesla. And that's why the stock is going up so much, because all the market's doing is looking into the future, saying this is more likely to happen and discounting it back to today. And so the reason why we like MATE or MAET, that the product that you're listed in, is from your client's point of view, they can simply buy the stock on the exchange, and we can go and buy Ørsted in Denmark, and we have, and it trades on a daily price, and we like Ørsted a lot. We think this is going to be one of the next super majors. This is basically, they own all the offshore lease capacity around the world to build these offshore wind farms. It's like BP running around Iran in the 1970s. It's the same thing. Samsung SDI in South Korea is our battery play. They're the guys who built this big facility in Adelaide. You know, all the renewable facilities are going to have these big batteries alongside it. They're a potential structural winner here. Alphen in Holland is in the Netherlands is another great company that specializes in charging stations and fixing up the grid for all the different power sources that are going to be coming in. And so from that point of view, we just think there's a lot of really good ideas here. And simply, but when you buy MATE, all that MATE does is put money in the fund and we go buy these things. And then if you think we've, you know, lost our way, you can just take the money out again. It's a daily priced way of just getting access to all these ideas, because we can go and do it for you.
Pretty clear. Now I want to talk about some stocks in the portfolio, Nick. We'll drill down a bit.
Yep.
We always like an Australian bent when we ask these questions because we seem to be obsessed with Australian companies overseas. But I'm going to ask you about Atlassian. Now, most people read about Atlassian when they're reading about Mike Cannon-Brookes and Scott Farquhar having bought some big property up in New South Wales. I think they're up to about 10 lifestyle properties each now, and they live next door on the two most expensive properties in Australia. But putting that to the side, can you talk about Atlassian and actually explain what it does? Because I don't think it's particularly well understood as a business.
Yep. I'm just going to try and find my Atlassian slides. I've gone straight past them. Apologies. I'm getting lost in my own presentation deck. Here it is.
Okay.
Okay, so what's Atlassian do? Okay, so everybody on this call understands that software is quite important in your life. Okay, Zoom is a classic example here. And so what software's done in the last 10 years is it's gone into the cloud. And so once software goes into the cloud, it becomes much more useful. And the reason why is because you can collaborate. And so this is the structural trend we're following here. We know that cloud computing will grow. We think it's a $200 billion market at the end of 2019, having come from nothing previously. And quite simply because it's just easier to download and work on software on the internet than it is to have it installed in the server in your office. And I'm pretty sure no one on this call has a server in their office anymore. They're all effectively leaving everything in the cloud on these infrastructure as a service providers who are providing the meat or the data centers underneath it all. And on top of that, all these really clever companies are building amazing software, whether it's Xero here in Australia or Salesforce. And Atlassian is one of those. And so the software Atlassian is building is collaboration software. And so the collaboration software, Jira software is one of the main ones, but there are other ones like Trello, etc. And so what they're doing is if you're a disseminated team, started with programmers and IT workers in particular, and you're all working on a project, you can update that project in what they call collaboration software. And so their code in the US is called TEAM, T-E-A-M, for this very reason. And so all they're doing is not dissimilar to how Facebook grew WhatsApp or how Google grew Google, is they're basically giving their software away for pretty much for free, or in many cases, not a lot of money, to get teams to start using it. And once they start using it, then it becomes an integral part of your life in the same way that, say, Microsoft Teams has become an integral part of your life through COVID. And what we find with Atlassian, why we really like it, is there's a lot of people using their software. Sorry, I'll skip forward. They have nearly 200,000 customers in the world today. Wow. Growing at a huge rate. And that's not 200,000 people, that's 200,000 businesses. They're talking about the Fortune 5,000, not the Fortune 500. And the reason why we love that is because they've got thousands of customers, but if you look at their average contract value, they just don't charge them much money at all. And so a bit like WhatsApp or a bit like Google, you're just going to get stuck on this software. People are stuck on this software all over the world. And over time, they'll be able to add features, they'll be able to upgrade it, and they'll be able to improve the price. And so you've got a genuine chance of this company being easily as big as Salesforce, but potentially, even start to challenge things like Microsoft, at least software side at some point in the future. They're building the same building blocks around it, if that makes sense. And the last reason why we like it so much is, that the sales and marketing, it's got this viral-like adoption. They spend all their money on R&D and they spend no money on sales. And so put simply, this is their revenue today. That's their services addressable market. That's their total addressable market. So, they've got 15 million users today, but there's 1.1 billion knowledge workers in the world who can use email. And so they've just got this huge runway of growth in front of them. And all they have to do is keep developing the product, keep executing on the sales, do the right thing by the customers, and the share price will take care of itself. And I honestly, big statement, we may as well do them. It's a private room. This will be Australia's largest company. It's reasonably easy to work it out from here, purely because Commonwealth Bank, I think, is currently Australia's largest company, and it banks Australia. Okay, Atlassian is software to the planet. Okay, it's software to the planet that the planet loves, and so all they have to do is execute over a long period of time on this runway, and inevitably this should be the largest company in Australia at some point in the future.
Interesting, really interesting. Next one, Nick. HelloFresh, which I think people would be somewhat or maybe familiar with in Australia. Another interesting business.
Yeah, okay. So I get a lot of pushback on this one. So
yeah, look, I must say to start with, it seemed to be a pretty saturated market with lots of businesses trying to do the same thing in this space.
Yeah, and so the funny thing about HelloFresh is everyone's got a box and had like a smelly pumpkin or something in it and cracked it, and then that's the feedback I get from a HelloFresh box.
Yep.
And so I want you to think. And again, it's a very similar argument to what we're saying with Atlassian. So the total addressable market is just so big, and the opportunity is so big that they've only got to get a little bit right for this to work. And so what we're talking about is e-commerce. Okay, e-commerce, I think everyone's familiar with now. And what you'll find as the world shifts to e-commerce is you effectively shifted through categories. And so this is a good slide that shows that. And so when you started doing e-commerce, you probably bought toys online or electrical appliances online. You're happy doing that. And you're happy doing that because you knew you wanted a new iPhone, or you wanted, a DVR, all these things that you used to buy online. And you still buy online today, or if you like us, Patrick, golf equipment, sporting goods, riding equipment. And over time, what happened is you got more and more comfortable with e-commerce, and you moved into sporting goods, then you moved and started buying clothes, and now you're happy to buy furniture online, if that makes sense. And over time, you even start buying consumables like toilet paper, etc.
Isn't media amazing here, Nick? I can only imagine that's the shift of people buying newspapers and magazines to looking at them online and having subscriptions.
Yeah, it's actually more just buying digital media. So you don't buy a DVD anymore. You buy Amazon, etc. So these are all things.
What you're saying here is groceries is the biggest market, but it's only got 3% penetration, and it doesn't need to grow by much for this to be a good story.
Correct. And so that's the point. Groceries is the biggest TAM in the world. And something happened over COVID, which is that we all got used to buying groceries online because we had to. And so to give you an idea of the opportunity, these are the sales of grocery stores around the world. These are the sales of HelloFresh. And so what we're saying is it's not actually a subscription meal kit. It's just another way of ordering your groceries. It's just part of your daily grocery bill. And so I know in the Griffin family household, HelloFresh is a weekly occurrence now. And that really was happening before COVID, but got ingrained during COVID. And I think what you've got to start thinking about is not is this a great product and doesn't have a lot of competitors? Of course, it's got a lot of competitors. So you've got to think more about what happens when they deliver a box to your house once a week, and what else could you put in that box? And so we just think people will get used to it. The opportunity to HelloFresh is huge. The last thing just to flag on HelloFresh is they are number one in the world. So we've seen this movie before. They've built all the facilities around the US to give them a 50% market share of the US market, and all of their competitors are effectively nowhere. They're more than a 50% share of the Australian market. All their competitors are effectively nowhere. This is a logistics game. It's a logistics game where you need to spend a lot of money at the start. German company run by a couple of guys who started it when they're 23. They're now only 34. We've met them multiple times. They get it. They know what they're playing for. And yeah, the last thing we love about HelloFresh is the stock's not even expensive. We only have to pay 30 times earnings, or about 24 times EBITDA for this company. And not a lot has to go right. Not a lot of the share of groceries have to shift to online, and an even smaller share has to shift to food boxes. And an even smaller share has to go to HelloFresh to get this company to actually triple from here. And we think that could actually just be the start.
Very big gap there between your price target and the current share price, Nick.
Yep. And I think it'll do that in 12 months. You should see our 5-year price target.
Yeah. Okay.
So yeah, lots go. Just not much has to go right here.
I feel like putting a disclaimer back up now, but anyway, nonetheless.
Yeah. So I mean, look, from our point of view, we've done the work on this company a lot. It's actually already gone up a lot. But yeah, there's always only a few winners, and we think this could be one of them. Yep. And if it's wrong, then our stop losses will take care of it.
Yep. Cool. Last stock I'm going to ask you about, really interesting business. And when I was doing some research on this business, I shouldn't have needed to, Nick, but as I was doing it, I could feel my hair graying and the lines in my forehead getting a little bit wider, because PayPal is 20 years old, which is really, really hard to believe. It was owned by eBay for a very, very long time. And an interesting one, Elon Musk was a founder in the business.
He was.
So can you talk about PayPal? Again, another one where it feels like HelloFresh. there's lots of competitors and lots of people fighting for the same sort of space.
Yeah, and I think what we're saying on both of these is that, and again with HelloFresh, is you can all win together, because the loser's supermarkets, and in PayPal's case, the loser is banks and cash, and so there's just such a large area to take share from that they can all win together. And let me just show you what I'm talking about. So digital payments is something we followed for a long time. I showed you right at the start the MasterCard slide. And so for a long time, this has been about the shift from physical cash to digital cash. And I'm pretty sure, I used to walk around doing meetings 5 years ago saying you'll probably end up never using your wallet again. And now no one carries their wallet around, if that makes sense. And so this
don't take cash at the moment.
Just no one takes cash. And, and that's what drives, you reach that inflection in the S curve where no one's got cash, so all the people who aren't on digital have to go digital. So they have to get a Square terminal. The church has to have a little search, even for donation now, because no one has any cash. So you just tap and go at the church. You tap and go everywhere. So we're basically going, and here in Australia, we're right at the forefront of this, by the way. We are the second most adopted country for digital payments on the planet. It's us and Sweden, and we're in the 90%. And what's fascinating when you talk to Visa is they say it takes 4 years to get from 0 to 20%, and then it goes from 20% to 90% in the next 3 years, and then it takes 4 years to go from 90% to 0.
Sounds like exponential growth to me.
That's an S curve. It starts like this, goes like that, and finishes like that. Okay, so payments are going to go 100% digital. Everyone agrees with me now. And so when they go 100% digital, a funny thing's going to happen.
Only took a global pandemic for us to get to that stage, Nick.
Correct, yes. But they are going to go 100% digital. Everyone agrees, okay? So stop carrying your cash around if anyone still is. When that happens, a funny thing's going to happen. So all the fintechs, like your Afterpays, your PayPals, your, they're basically operating in this really small part of the market, which is e-commerce, digital consumer financial services, peer-to-peer remittances where you pay somebody, other digital services, So not a lot of people borrow money, online, and not a lot of people, use PayPal or even Afterpay in a shop, but Afterpay and PayPal are starting to get into it. But once you go 100% digital, eventually, you can move into this offline and in-store, you can move into the cross-border payments, and you can move into these domestic non-cash payments, etc., which is, paying babysitters, etc., peer-to-peer payments. And so from that point of view, the pie is much bigger here. And so what you're going to see is a lot of these companies, whether it's PayPal or whether it's Square, or whether it's Afterpay, they're going to move into financing. They're going to move into merchant solutions for the merchant, solutions for the consumer. They're going to collect a lot of data from that that's going to help them sell better products to you at a different time. And they're just ultimately going to continue to chip away at this revenue that the banks are making. And this is the revenue of the top 100 banks in the world. And every bank in the world is effectively overcharging for FX, overcharging for merchant acquiring, overcharging for offshore payments, and all of these things are just going to get chipped away at by the payment companies. Last thing I'd say, very similar to what I said about Atlassian, is at the moment the world is made up of banks that live in countries. Does that make sense?
Yes, it
and
does.
So the reason why they all live in countries is because you used to go to a branch and you used to get a money box. You had to go to a bank branch, and you had like 4 banks in Australia, and you got 3,000 banks in the US. You got 6 banks in Canada. Okay, once cash disappears, and once you don't go to the branch, you don't actually need banks in a country anymore. You can have a global bank. You can
actually stopped Dolomite accounts in schools, Nick. I was shattered by this.
Yeah, correct.
I was very excited when I got my first Dolomite account.
And so when you think about PayPal, you think about all the things it can do. And you think about the fact that I'll give you a really simple example. On your Dolomite example is a great one. You're not allowed to own a bank account for a child under 14 years of age that they can actually use to buy anything. And everyone on this call who's got kids under that age gets a kid who hassles them saying, I want to buy this, I want to buy that online. I need to buy some more stuff for Minecraft. I need to buy some stuff for this. So what do? You set them up a PayPal account and go spend your money as much as you want, mate. Here's your pocket money. If you want to dust it on a video game, knock yourself out until you run out. And this is what's going to happen. So you're going to create this great unbanked, and the great unbanked are going to be then banked to by these digital platforms, and all they're going to do is take share from the other banks. And so coming back to your point at the start, I know there's a lot of competitors, but they all win together because there's one big loser. That's called banks. And in the same way, all the digital payment players won before because they all won together because the one big loser was cash. And so from that point of view, we just don't see it as a problem. And PayPal's the biggest and the best, 300 billion market cap, There's absolutely no reason why this company can't be $1 trillion internet company in the future. We already have 4 in Microsoft, Amazon, Google, and Apple, and there's just no reason why PayPal won't join them at some point in the future.
Very clear. Final question, Nick, and I know we covered this a little bit earlier, but we're going to sort of pivot another question off that. So the fund held up really well during the downturn. I don't know how, and you talked about the tools at the start, but nonetheless, the fund produced a positive return, in February and March 2020, when the Australian share market fell by 35%, sort of peak to trough. So I think that's quite incredible. Maybe just end with why it held up so well, the sort of things that you were doing. And I'm pretty keen to talk about active versus passive. There's a massive flow to passive investment strategies at the moment. It just gets stronger and stronger, which I think is incredibly silly, but nonetheless.
Yeah, so there's 2 things. I mean, we discussed it very briefly before, but the one thing that happened during COVID is 2 things happened. One, our insurance policy paid off massively, and we had chosen to buy insurance because it's important to remember when you're an absolute return fund, your goal is to protect capital first and make money second. And it's important to remember COVID was around for like a full 5 weeks before it tipped the market over. It really was that day that Italy decided to lock down that you realized that we're in a lot of trouble here. And so from our point of view, it was a fairly easy decision for us to just say, why don't we just buy some insurance? Why don't we just buy this put option? We'll know in the next 6 weeks if COVID's going to be a disaster or not. We were off buying climate change stocks and looking at digital stuff. We didn't think it was going to be a big deal, but it was a very easy decision to buy that insurance, and that insurance paid off. And I'm not saying we're going to have insurance all the time. We do right now have a little bit of insurance on the market, but we do often buy put options just to create this safety net underneath the risk that we're doing. So that's what actually paid off that time. And to be fair, Patrick, we'd been buying that insurance for 3.5 years beforehand on an intermediate basis, and that was hurting our relative performance over time.
But that's why you buy insurance.
But that's why you buy insurance, correct. Second thing you can do is you can obviously do the short selling that worked out quite well. And the last thing down the bottom here is super important is we can be active. We don't have to be fully invested all the time. So the reason why the market fell 30%, we only fell 12%, is come back to your point about active management, is we were very quick to stop ourselves out of things like Airbus that we owned, or to stop ourselves out of luxury good companies that we owned. We're very quick to do it because we realized very quickly that there was a problem. There's nothing great about COVID, quite frankly, but the interesting thing it exposed was exactly what you say about passive management, is everybody just went and sold the market. And so the whole market fell. And I can assure you, I was sitting in this very room and we're sitting around a table going, well, Airbus and Amazon have fallen the same amount. And that doesn't make any sense to us. Airbus should be going down and Amazon should be going up. So why don't I sell my Airbus and buy more Amazon? Or quite simply, I'm rapidly cancelling every international trip I'm going on, but at the same time, I'm moving my entire business to Microsoft Teams. Yet Boeing and Microsoft are falling the same amount. It didn't make any sense. And that was really just passive funds just selling the market, passive funds selling the futures. And so what that created for us was this really nice opportunity, which ultimately drove the 40% return we did last year, was A, we could protect because our mandate was flexible, but B, when we did put the money back to work, we just pivoted very strongly to tech because we knew tech would be the winner. We knew that they would actually grow out of this crisis and that their earnings would grow. And that's what happened. And that's why their share prices went up, because at the end of the day, share prices follow earnings, which is what we said right at the start.
Cool. Now I'm going to end with a non-serious question. You're Melbourne-based fund manager, which is great. We're very fond of Australian-based fund managers, but particularly Melbourne-based managers. Can you talk a little bit about the name, Nick, and what a Munro is?
Great question. So Munros are mountains in Scotland, over 3,000 feet. There's 282 of them. And your goal is, if you live in Scotland, is to go climb them all. And I've climbed, I don't know, about 20, 25. But the long story short is that I spent a bit of time living over there. I married a local. And during the end of my 10 years at K2, we went back to Scotland for 3 years, and I worked out of Scotland for 3 years with a colleague who's with me here at Munro. And during that last 3 years, we looked around at the Edinburgh fund managers, and we just loved the way they did it. And they were partnership.
They're good fund managers, the Scots, aren't they, Nick?
Yeah, they've got moths in their pockets, and they're good at what they do. And so I'm sorry.
Short arms and long pockets, or something like that, isn't it?
I hope there's no Scots on the call. I love you. I love Scotland. I love the country. But the point is
you married one, Nick.
Correct. But the point is they've run these businesses in many cases for nearly 100 years. They're partnerships like we are. They sit in a faraway place and take really long-term views of the world, which is a lot of what we talked about today. And we just love what they did. So Munro is a homage to them. And if you go to the website, you can find that story. And yeah, if also just to be clear, we brushed over a lot of stuff today. If you go to the website, we're very transparent about what we're doing. There's lots of videos which will cover a lot of the stuff we talk about because yeah, we just want to be your global growth investor. And as I said, it's through that one code on the ASX, you can get access to the whole world. And that's the dream that is Munro, and that's what we built the business to do.
Beautiful. Right on 11:30, Nick. Really appreciate your time this morning.
Thanks very much for your time, Patrick. Appreciate it.
Thanks everyone for joining the webinar. Stay safe and well.